All right, today we're going to dive into a really interesting analyst report on a company called Cementos Pacasmayo. We're going to unpack what happens when you see what looks like good news, but it might not be as simple as it seems.
So, let me ask you a question. A stock's price target goes up. Is that an obvious time to buy? I mean, your first instinct is probably, yeah, of course. But is it really that simple?
And this is where it gets really weird. Check this out. On one hand, you've got the price target going up to 750, but on the other hand, the analyst rating is underweight. So, wait a minute. How does that even work? How can both of those things be true at the same time?
Okay, before we get any deeper, let's make sure we're all on the same page with that term underweight. It's basically a fancy way for an analyst to say, hey, we think this stock is going to do worse than the rest of the market or its peers. It's a red flag, pretty much telling you to steer clear or maybe even sell.
So, what is really going on here? This apparent contradiction is what makes this so fascinating. We're going to pop the hood, take a look at the engine, and figure it out. We'll unpack the good, the bad, and how it all leads to that final verdict.
All right, let's start with the reasons for optimism. Let's dig into the good news in the report, the stuff that made them raise that price target in the first place.
First off, the company had a really strong third quarter. I mean, look at these numbers. Revenue was up 11% compared to last year. EBITDA was up 4%. And maybe most importantly, they beat what the analysts were expecting. That's always a good sign.
Now, you're going to see that term EBITDA all the time. Don't let the acronym scare you. All it really is a way to measure a company's core profitability from its actual operations. It strips out all the fancy accounting and financing stuff so you can get a clean look at how much cash the business is really generating.
And here's where we see the company's real strength. A massive 47.5% gross margin is forecasted for their main business, cement. Just think about that. For every dollar of cement they sell, almost 48 cents is gross profit. That is an incredibly healthy margin. And because that core business is such a powerhouse, it gives analysts a lot of confidence about the future. They're basically saying, wow, if they're this good at making money from cement, we think they're going to sell more and make more next year. So, boom, they raised their future revenue estimates for 2025. Okay, so things are looking pretty good, right? Well, not so fast, because now we have to talk about the cracks in the foundation. Let's uncover the bad news and the hidden risks that are bubbling under the surface.
And this slide, wow, it really tells a tale of two different companies under one roof. On one side, you have that amazing 47.5% margin from cement. But on the other side, the concrete business is actually losing 2%. They're literally losing money on every sale.
And get this isn't just a one-off bad quarter. The concrete business has now posted negative margins for 5 consecutive quarters. That's a long-term problem that's just dragging the whole company down.
And as if that wasn't enough, on top of all that, their operating costs are expected to go up. So you've got this one part of the business bleeding cash, and now the cost of running the entire show is getting more expensive.
This stuff falls into a bucket called SG&A, which stands for Selling, General, and Administrative Expenses. You can just think of it as the company's overhead. You know, all the costs of just keeping the lights on. Salaries, marketing, rent, that kind of thing.
So why are these costs going up? Well, it turns out there's a new 3-year labor union agreement. And here's the kicker. The way the deal is structured, a bunch of higher bonuses get paid out in the first year, which is 2025. This creates a big, even if it's temporary, spike in those SG&A costs.
All right, let's step back for a second. We've got the good, a rock-solid cement business. And we've got the bad, a weak concrete business and rising costs. So how in the world do analysts weigh all this stuff to come up with their final verdict on the valuation?
And this is where we find a really crucial clue in the report. It says, we are raising our Deck 26 PT to $7.50 largely due to FX. Aha! So a big reason for that higher price target wasn't even about the company's performance. It was about something called FX.
FX just means foreign exchange. See, Cementos Pacasmayo is a Peruvian company, so its stock is priced in their local currency. If that currency gets stronger compared to the US dollar, then the stock price in dollars just goes up automatically. It has nothing to do with the company selling more cement. It's just a currency conversion thing. It's super important to remember that.
So, the final piece of this puzzle, the thing that really ties it all together, isn't about performance at all. It's about price. It's about what you're actually paying for the stock.
Now, to figure out if a stock is cheap or expensive, analysts use all sorts of tools.
A really common one is this thing called the EV to EBITDA multiple. All you need to know is that it's a yardstick. It lets you compare the valuation of one company to another in the same industry, like an apples-to-apples comparison.
And when you look at that yardstick, you see that Cementos Pacasmayo is trading at a multiple of about 6 times EV to EBITDA. Here's the thing, that's pretty much the same or maybe even a little more expensive than its direct competitors in Latin America. So simply put, it's not a bargain.
And that is the heart of the problem. Why would you pay the same price or even more for this stock when you could buy one of its peers that's growing faster or has a foothold in the huge US market? For the analyst, it's a simple calculation. There are better deals out there.
So let's put it all together. You've got the good stuff, strong results and great margins in the cement business, but that's being held back by the weak concrete side and rising costs. And the nail in the coffin? The stock is considered richly valued compared to its peers. And that, right there, is how you get a higher price target and an underweight rating at the same time.
And all this leaves us with a really big question, something every investor has to ask themselves. When you're looking at a company, what's more important? A good business or a good price? Is it better to pay up for quality or to hunt for a bargain, even if it has some flaws? It's a classic debate, and there's really no easy answer.